This is our flash briefing here with Andy Anderson, one of our wealth advisors, our director of financial planning. And today we are going to hop into a topic that has been kind of talked about a lot over the last few years, and that is the 60/40 portfolio still relevant? There's probably some more inflammatory headlines that are out there, but the way we view it is this portfolio, are the rules of thumbs that have held true for a long time, are they still true? Or are they not? And if so, what do we need to consider or do about that? And so, Andy, we'll dive into that in a second. But before we do, how are you doing today?
I am great. I am great. Can't complain. It is a little rainy, but hey, we get that every once in a while, and then we get some grass and flowers, so it's all good.
Yep. It's that time of year where things are blooming, and I had to ask. I was watching baseball last night, and I have to ask you, as a diehard Cubs fan, how are you feeling at this point in the season?
You know, it's pretty much a lost season. I'm not expecting much from it, but to be completely honest, I'm having a lot more fun with this season than I have the past couple. I just think it's more exciting baseball, making more contact, less strikeouts. So
Yeah.
even though they're not great, it's still kind of enjoying to watch.
Yeah. Progress is always good, so it's good to see that at least they're putting a somewhat entertaining team on the field. So that's good for sure. So, well, good deal, man. Well, hey, let's hop into it. And so, let's talk big picture. A long time ago, people were debating, hey, how do I invest my money when I'm either in or approaching retirement to reduce my risk, but to still generate a large enough return so that I can pull out, 4% a year out of my portfolio, which is again, another rule of thumb. It's one of those safe withdrawal rates. And we've actually talked about this in the past. And so we might link that video in here. And so what's interesting, though, is we have entered a period where that is maybe looking like it's not true. So far, year to date, we have the U.S. aggregate bond index as of the end of the month of May is down just under 8.75% so far year to date. The S&P 500, so the 500 largest company stocks in America, it's down 12.79%. And what's so fascinating to me is the Vanguard Balance Index, so the classic 60/40 portfolio, is down 12.07% year to date. Now, historically, that should not happen. You own bonds in a portfolio to help smooth out that risk that you inevitably receive from the stock market. Unfortunately, though, because of some of the economic factors that we'll talk about, Andy, that is looking as though it's not going to hold true going forward. And so when we even zoom out and we look back over all the way back to the start of 2005, what we see is that bonds have returned about 3.19% a year. And the S&P 500 is up at 9.39% a year. And the Vanguard Balance Index is at 7.29% a year. And so from an investment standpoint, over the long term, the 60/40 portfolio has delivered the returns it's expected to. However, in the last 6 to 18 months, we've started to see that story flip, and we think it's going to be flipped for a while. And so, Andy, when we look at all those numbers and we start diving into the core of the issue, what would you lay out as kind of the most important things for us to keep in mind here?
Yeah, so I think the 60/40 portfolio, that is a tool that has been used throughout time for retirement planning and portfolio planning. But the reality is, one tool is not correct in every environment. I mean, you think about, we talked about how it's raining today here. Think about what you're going to wear each day. You're going to wear a rain jacket if it's raining, but that's not going to be correct if it's 95 degrees and sunny out, right? So when the environment changes, the tools we use to accomplish a goal change as well, or should change. There are time periods and environments in which a 60/40 portfolio is going to do exactly what you want it to do. It's going to reduce volatility, provide you solid returns to sustain an investment portfolio over time. But environments change, and right now we're in a different environment than we've seen previously, for the most part, to where with interest rates rising, the value of bonds is dropping at the same time that the overall stock market is dropping. So when we have time periods like that where the specifics are a little bit different than maybe we're used to, we have to start looking to say, are we still using the correct tool? It may still be a great tool, but it may not be right for the situation we're in. So at Creekmer, we're looking for those other tools out there, even some new ones that have come to market in the recent years, to say, how can we still accomplish this goal of reducing risk, extending portfolio longevity, but doing it in a way that's effective, most effective based on the facts we have right now.
Yeah. I like that analogy that you said, that you laid out, showing how sometimes certain seasons there's a tool that's right for it. We have a great chart here that kind of breaks down the last 2 decades, or the decades from 2000 to 2010, and then 2010 to 2020, and it kind of shows how during those seasons, the 60/40 was a great tool in one decade, and in the other decade it wasn't. Want to walk us through that chart and those returns, Andy?
Yeah, so I've got the chart here, and basically we're looking at different time periods. So we're looking from 2000 through 2009. Your typical 60/40 portfolio would have returned, when you factor in inflation, a real rate of return, actually negative 0.3% year on year in that decade there. If we look out just to the following decade, 2011 through 2021, there's a significant change there. The environment changed, so the returns change as well. And we have a real return, annual returns of 9.1%. So even from one decade to the next, we're seeing vast differences in the rate of return and how effective that 60/40 portfolio is.
And so, whenever we go through a season where things that maybe have been true in the past aren't holding true so far, you kind of alluded to how it's our job to always be looking for better ways to improve or better tools for the season that we're in. Can you walk us through just kind of a list of some of those tools that you are talking with your clients about right now?
Yeah, so some of the tools have been around for a while, but maybe we're using them in different ways than maybe we had before. Some of them are new tools that have come to market, in the recent years, past 5, 10 years that maybe weren't available previously. So some of those, we've talked about with many of our clients, things like buffered ETFs that provide a set level of protection on the downside while still allowing for growth potential on the upside. Tools like fixed index annuities that eliminate stock market risk on the downside, but again allow for growth based on stock market appreciation. Tools like structured notes, we've been offering those to our clients recently that provide that same type of resource of saying, let's protect against loss potential if the market goes the wrong direction, but let's have the potential to participate in that growth if it does turn around and start heading up. So those are three of the main tools we're using right now that all try to accomplish that same goal of let's reduce risk and maybe a time of uncertainty, a time of rising rates, but let's also have the ability to participate in the growth and add to the appreciation potential if we do get a stock market that's heading up.
Yeah. Now, Andy, is it a one size fits all approach? Is it, hey, you get this tool and everyone gets it? Or are we trying to customize the tools that we're using and the ways in which they're being deployed based upon the individual's goals? Because I think that's really important for people to recognize that we're all unique. The world is unique. We have unique goals. And so our approach needs to be different based upon what their goals are. So, from what you've experienced recently, how are we deploying those tools to help people better achieve their goals?
Yeah, so I think you're absolutely right. It's specific to each individual client. We may have groups of clients that are all trying to accomplish the same thing. We may have our clients that are working towards retirement in the next 5 years. They're all similar. They all have the same goal, but their specifics are going to be vastly different. How much do they want to spend every month? What types of assets do they have? What's their legacy goal for leaving money to heirs and charities? The specifics are going to be different. The time frames are going to be different. So because of that, the tools we use have to be different as well. Not only the tools, but also the combination and the amount we use in each tool has to be different. So those three products I mentioned, the buffered ETFs, the fixed index annuities, and the structured notes, they each have their own strengths and weaknesses. Some may be more liquid than others. Some may protect against loss in a stronger fashion than others. So, as the advisors, it's our job to come into the situation and say, what's the goal the client is trying to achieve? And then how can we utilize the tools that we have available to us in the best combination to most effectively reach those goals that the client has laid out for us?
Yep, absolutely. I think you nailed it, Andy. And so, how we would wrap this up, we would encourage all of you, if you have not met with one of our advisors recently, or you've never sat down with us, we would encourage you to reach out. We'll set up a 15-minute conversation. It's free of charge. We're not pushy salespeople here. We just want to help you get to your why, get those big goals outlined, and then walk through. Do you have the right tools in your tool chest right now to help you achieve that goal? Or are there things out there that can be done to improve your situation? On the investment side, some of the tools that we talked about here are huge. But on the tax planning side, on the income planning side, Andy and his team on the financial planning side of things in our firm do a fantastic job of finding other ways in which we can further optimize and improve the tools that you're using from a day-to-day basis. And so we would encourage you, shoot us a call or send us an email. We'd love to spend 15 minutes talking about if we'd be a fit to work together and how we could best help you achieve those goals. So thanks for your time, guys. Hope you found this interesting, and we look forward to talking with you soon.